All right. Well, welcome everybody. I apologize for the delays. We were having some technical difficulties from our end and just sorting out some issues. So thank you all for your patience. Without further ado, we will just jump right into it. This is going to be today's self-directed IRA Saturday class, talking about how to create recession-resistant investing through strategic lending with Wendy Sweet, and Bill Fairman. So, the way that we're going to kind of structure this today is a little bit different than our typical webinars. If you guys have been with us before, I do just want to give a quick disclaimer as usual. And for those of you that have not been on our webinars before or not familiar with Quest, we do not provide any sort of tax, legal, investment, or deal structuring advice. So this webinar is purely for educational purposes, so please bear that in mind as we bring up our presenters and kind of go through some of the information today. But without further ado, I will go ahead and just pass the baton off to Wendy and Bill.
Excellent. Thank you so much, Colin. I
Absolutely.
Appreciate it.
Yeah, thank you guys for being here today. We're really looking forward to having y'all present a little bit.
Well, I'm going to start off by saying happy birthday to my sister, who
Thank you.
home in South Carolina today.
Yeah.
She's like 39 years old. Unbelievable.
Yes, happy birthday.
It is very popular. I liked it so much, I thought I'd do it another 30 years.
Great. Well, I will jump off here, guys. And for everybody that is listening in, any questions y'all have throughout the presentation, go ahead and put them down in the chat box or in the comments, and we will get them up to Wendy and Bill as we go throughout.
Awesome.
Excellent. I already see a chat. Wendy says, thank you, Scott, for the happy birthday. So I know we are in uncertain times, so we want to put together a education for trying to be diversified as well as in a recession resistant space in real estate. And I think we have that covered. We've been in this space for a while, but go ahead and jump ahead. What we're going to cover, and I apologize for all the words on one slide due to the streaming. We can't do individual animations on this, so I apologize for all the words. Yeah. So we're going to talk about due diligence, how to protect yourself, the most defensive space in real estate at this time and why, the current market and the opportunities that are in it, as well as how we are uniquely qualified to talk about this space and how to invest like the ultra wealthy. Why are we qualified? Well, Wendy, these first two lines are yours. Since it's your birthday, you're going to talk about how long you've been in the business.
I have been in the business a long time. I was one of those kids that, our mother, but Bill and I are brother and sister, and our mother was in real estate all our lives. So it was only normal that I would try to follow in those footsteps because she kept telling me, you always need something to fall back on. So I got my license when I was 21 and my broker's license in both states. I also started in the mortgage industry in, 2001. And that was thanks to you, Bill.
Is that a curse?
It was a good thing. It was a good thing. And I've been one of those investors that invested by accident at first because I just never sold my primary house and kept rolling. And I think it was after about 20 years of that, I realized, oh, you're supposed to make money doing this. And ever since then, I've loved real estate investing.
Well, just to show you that we are very seasoned in this industry, these numbers here, the 30 plus years in real estate, 7 years in the mortgage industry, the 20 plus years for me, all of that was prior to the crash of 2008. So that was the experience before the crash happened.
Yeah, because I've been in it longer than 7 years.
Right. So as many of you know, it was an awful period of time, especially if you were in the mortgage industry, and both Wendy and I were at the time. Wendy she had her own business, her own mortgage company at that point, and ended up having to close it. I had the best mortgage job ever in the world, and I ended up losing that job. And we found both of ourselves we were in a position where the industry had shrunk to about 25% of its size. And so obviously it was very hard to find work. We took different paths. I ended up driving this wonderful vehicle for a living. Gave me lots of time to think about things. And Wendy took a different path. You want to talk about that?
Yeah, I went to seminary. I realized I was measuring my life on my credit score and my success of my business, and realized I was really looking in the wrong direction for direction. And so that the whole situation with that crash was a blessing for me.
I like that. That's trying to find the right place in the wrong place.
That's right. So I went to seminary and crawled into a cave, licked my wounds, still did a little bit of hard money on the side, but ended up getting right back into the business as soon as I graduated.
Yeah.
And Bill you're freezing on and off there, Bo.
So, and then, what happened with Wendy was when she got out of school and she started doing hard money on the side, the business started picking up, and she drugged me back into it, kicking and screaming.
He was.
And then today, we now have 12 people in our office, and then we have several contract employees as well as contractors that work for us. So there's about 20 of us now that really work in our industry. So things have changed a little bit. There was a place in the market. There was a need in the market for private lending, and we stepped in and filled that void. So here's our current market. So far, we've had 3 bank failures this year. Interest rates have gone up nearly 5% in 12 months, the fastest interest rate increase in history. There's $370 billion in commercial real estate loans that are set to mature in 2023. And what does that mean? If you get a commercial loan on a commercial property, they're not like your normal residential housing loans. They're not 30, 15, 20, and 30-year fixed rate loans. They're typically a 3, 5, and 7-year balloon note, meaning they mature after 3, 5, 7 years. You have to refinance these things. And the banks do that to make sure that they're staying up with current market. So what's happening now in that environment is that people are going to have to refinance at now nearly 5% higher rate than they had previously. We also have, around 5% inflation. Some people are going to say it's more than that based on the actual numbers. Yeah, we have out of control government spending, and then obviously we have international conflict and turmoil. As a matter of fact, this morning, I'm hearing that one of the Russian generals are now turning their attention to Moscow instead of Ukraine. So it's really messed up. Okay. So the challenge that we have is, how do we invest defensively while keeping up with inflation? The opportunities that we see are going to be still in the residential housing market. We are still 6 million single family homes short of a normal market. And what I mean by that is a supply and demand. We're 6 million homes below. I don't see values in residential dropping, especially now I say that real estate is local.
Well, yeah, here's what's interesting about that is we've got interest rates that are higher than they've been in several years, but we're really just getting normal. That's really where they are. They're just now getting normal. But we have such a strong housing shortage that houses are still getting multiple offers. They're still selling even higher than the listing price, depending on the market area. But most definitely in the Southeast where we invest, and in a lot of areas other than what we call the bubble markets. So it's really strange. Our whole situation here is really strange because we have this housing shortage, yet we have brick and mortar commercial properties, kind of dying a slow death because of all the online shopping that people are doing. Even in the higher end apartment buildings, we're seeing rents dip just a little bit. They're not quite as strong as they were. They're kind of leveling out. Now, they're still stronger year over year, but it's not what it was. The roller coaster fun time is over, and we're just in a really strange situation right now. Everybody's crystal ball is broken, and everyone is wondering, well, what should I be investing in? What's the best road to go down? And right now, it appears that single family housing is probably your strongest investment at this point.
Well, and if you want to break it down into sectors, we like the median price point homes for
Yes.
whatever area you happen to be in. Median price point allows for the most liquid of those properties because you have the highest number of interested buyers. You have first-time home buyers, you have investors, and then you have empty nesters are all going to be in that median price point range. As a bank, we like them. We're not actually a real bank, but in a bank mentality, you like those properties because they are the ones that are easiest to liquidate if the borrower stops paying you. They're the easiest to get rid of. You can get rid of them the quickest.
Or also, you can rent them.
Yeah. So for us, as a private lender, if you have a worst case scenario like you had in 2008 and everyone is a seller and no one is a buyer and we have to take these things back, well, we can easily rent these things for our expected returns because they're still in that median price point. It's very difficult to do that on luxury properties. The one thing about residential housing, whether it's multifamily or single family, is that whenever you're in any economy, you need two things: food and shelter, and that's the shelter business. Now, we did talk about commercial and a death, but it's not all commercial. We love lending on small strip centers without a anchor tenant. Why is that? This is not being really covered by the Amazon effect, so to speak. These are small businesses that are needed in the neighborhoods. Amazon can't deliver you hot coffee. They are not going to groom your dog. They're not going to cut your hair or do your nails. These are businesses that are going to thrive in that area. And what I like about these properties is that you could, if you're in the business of buying them, you could buy one like this and still make decent money on it and buy it at a different decent price.
Right.
Every 10 to 15 years, though, they need a little bit of a facelift. Parking lot being sealed and painted, and then these are some things that you can do to these small strip centers, and it's not really a large cost to make them look a lot better. So as you can see here, it's just little additions to them that will really brighten them up, and part of that is because you're trying to bring in people from the major roads that these things are usually sitting on, so they have to look decent for people to pull in and utilize them. Another sector that we like is self-storage. Apparently, we as Americans have an unhealthy relationship with our junk. We tend to hang on to it. We're emotionally attached to it. As we move up the economic ladder, we buy stuff and we have no place to put it. So we put it in storage. On the way down the economic ladder, you're trying to downsize. You got no place to put your stuff, but you don't want to get rid of it. And then if you inherit something and it's been in the family for a while, you have an emotional attachment to it. You're not going to get rid of it. You'll hang on to it for a while. And it's a running joke in that industry that you're going to store $500 worth of stuff. You're going to keep it for 3 years and pay around $3,000 to keep it stored.
That's right.
Now, what we're looking at are self-storage like you're seeing here, but you can also do redevelopments. So some of these bigger box stores that are suffering the Amazon effect, you can easily take that building and convert it into something like this, where it's all temperature controlled. And then you have the units in there all inside of a nice temperature controlled business. So we were talking about the most defensive space in real estate, and that's not owning the property. It's being the bank.
Right.
So Wendy, I'm going to let you start here with creating notes and purchasing existing notes, and kind of go through the differences, if you don't mind.
Well, so many people think that creating notes is difficult, and it is not. You're creating a note is a promise to pay. So whether your note is 7 pages long, 1 page long, or 77 pages long, it doesn't matter. It's a note. It's a promise to repay. That's really what being the bank is. And they think, well, how can I come up with, the terms? Well, you're going to come up with terms. If you're going to be a lender, you're going to come up with terms that benefit you, but also benefit the borrower. So you're going to come to an agreement on terms. That's how you create a note. Once you come to that agreement, any attorney can help you write that up for you. And the borrower is the one that's going to pay for it. That's part of their closing costs to do that. So creating notes is actually a very simple thing to do. You do need to be aware of what the usury laws are in the state in which you're lending in, where the house or the property is located. You're going to go by those laws, but creating the note is really the easy part. Now, the even easier part is to purchase a note that's already existing. Companies like us sell them. There's lots of people out there that create notes, and their goal is to turn around and sell it to an investor, someone who wants to hold on to a note. And it might be for 2 years in length. It might be for 2 months in length. It might be a 20-year note. You have to look at what works for you. The other thing I love about purchasing existing notes is you don't even have to buy the whole note. You can buy partials, just part of the note, payments in the beginning, payments in the end, 50% of the note, 25% of the note, whatever it is. You can buy any portion of that note that you would like to buy on that. When you're purchasing existing notes, though, you need to make sure that whoever underwrote that note, whoever did the due diligence on that note, the borrower and the collateral that note is against, you need to make sure that they have done their due diligence, which means you need to do yours and trust but verify. Make sure that all the questions that are asked, all the things that you need to do to create or purchase a note, that you have gone through what that asset is, what the borrower's ability is to pay that back. What's the history on that? Have they been paying on time? Also, what is their exit strategy? You need to know how long they plan on staying in it and what they're going to do to pay it off. Is it something that can be refinanced, or are they intending on selling it? What's the purpose?
Yeah, and that there's also a business there where you can not buy just performing notes. You can also, there's another business buying defaulted notes. And you're thinking, why the heck would I want to buy a note that no one's paying on? Well, it's still a lien on the property. You can't foreclose, but that's not your goal. Your goal is not to foreclose on the property. Your goal is to work it out with the borrower. And you're certainly not going to pay full price for the note that you have to work out with the borrower. So you can get, if you get enough of a discount on that note, then you have plenty of room to work with that borrower to see if you can get it reperforming by making modifications to that. Now, I know that's all of this sounds like a lot of moving parts, and it is. Mm-hmm. And there's plenty of ways that you can work with other people that have done this before as a mentor. There's plenty of courses that you can take, and we have some folks listed here in resources that can help you do that as well.
Yes.
But the note business, one of the reasons it's very defensive is because the lender is always going to be in a better position than the owner. As an owner, the borrower, you're into the property basically for anywhere from 80 to 90, even 100% of the property, essentially. But as a bank or as the lender, we're typically not into any property for more than 70% of the value. There's a big difference. If it goes south, you have a lot more cushion between what the actual value of the property is and how much is owed on it. Another reason I like the lending space is because you can control the asset without being responsible for the asset. So you're not having to do anything but collect the money. Now, again, you have to be responsible enough to make sure it still has insurance, the place taken care of, but you're not the one taking care of it. You're not the one paying for the insurance, that type of thing.
And the taxes being paid, and yes. You can get a third party company to do that for you as well.
One of the benefits that's very important, especially since we're talking about IRAs, is that there are no tax benefits whatsoever to holding notes and getting income from notes. So it makes sense to use your tax deferred or tax exempt account to invest in these. If you're going to be tax efficient in your investing, you want to, in my opinion, you buy property with cash. Now, there's plenty of people that buy property in their IRAs, and there's good strategies for that as well. But overall tax efficiency, you use your cash to buy properties with, so you get all the benefits that the government gives you tax-wise by owning property, and then you utilize your tax deferred or tax exempt accounts to be the lender. Or do something that has no tax benefits with it. That way you're still diversified, as well as you're going to be most tax efficient with your retirement accounts.
You know, a lot of people too have concerns that, well, what if they don't pay? You know, what if this note's performing and all of a sudden somebody loses their job, or they get a divorce, or some sort of tragedy happens? Bad things happen to good people all the time. And there's always a chance that they're not going to pay. So the worst thing that could happen is that you would have to foreclose on that property. And people are so afraid of going through those motions. Now, in every case, you should try to work it out. See what you can do about modifying the loan, giving them an opportunity to pay it back, or to make up what they've missed. You're always better off in trying to work it out so they can pay it. But going through that foreclosure process isn't as scary as people assume that it is. It can take a while, depending on what states you're in. You know, we're seeing between 6 months to a year. We've actually witnessed one that went almost 3 years in Oregon. So take from that what you will about Oregon. But you've got to understand what the foreclosure laws are in the state that you are lending in. And it's not where the person lives or where you live. It's the state in which the property is located that you're lending in. Understand what those laws are so you're prepared for worst case scenario. But
Yeah, it's all part of your due diligence process.
Yes.
What are your risks? If you're in a state that it takes you longer and longer to foreclose on, then you know what? You're going to charge maybe more points or more interest. If you're the beauty of creating notes is it's exactly what you're doing. You're creating a win-win for you and the borrower. And in my opinion, I would stay in a shorter term and what we call commercial. You're lending to other real estate investors for investment property. Now, there's also great, I'll call it solace in lending to somebody longer term, because most people do not want to make loans every 6 months and turn around and have to find a new loan and
It's a job.
go through the process again. What's the alternative there? Well, you could invest right alongside of other businesses. There are plenty of businesses out there that are in the lending space and the note space that you can buy notes from them. And as soon as that one pays off, you buy another note from them, assuming they have one available at the time. And they have the knowledge, and they will, if one of them does go south, they're going to help you work through that process as well. Right. So you're not, but I always tell people that they need to find like-minded people to work with and try and work with a mentor through some of these. If you're really new at it, you don't know anything about it, my suggestion is that you work with a company that already does this for a living. They already have the knowledge. They've already been there. If you're an accredited investor, most funds that do lending are only taking accredited investors. There are some that you can do that will have a fund that allows you to not be accredited, but there are fewer and farther between. So if you're not familiar, an accredited investor is someone who has at least a net worth of $1 million, not counting your primary residence. Or if you make an income as a single person of $200,000, or as a family, it needs to be $300,000. There's some other designations there as well. If you're a CPA, if you're a licensed broker dealer, or if you already work in a fund and you basically know what you're doing, you have an important enough role in that company that you understand. Really what the government wants to see is that you're a sophisticated enough investor that you know what you're getting into. But for the most part, most people are going to fall into the $1 million in net worth, not counting your primary residence or the income side. Getting into a fund is a couple of things you need to think about. Are you a true passive investor, or are you an active investor? If you like to be in the mix, if you like to play the game, getting into a fund is probably not a great idea for you. Because if you're one of those types, and you know who you are, if you're a micromanager of everything, you're just going to drive yourself crazy and the fund manager crazy. So don't even consider putting it in a fund. Go ahead and just do it on your own. Play the game. There's nothing wrong with that.
Purchase notes, create notes.
Yep. You can do all that. But I don't suggest you putting it into a fund, because you have no control. Once it's in a fund, it's truly passive. Now, you still have to do your due diligence on each fund and fund manager, and making sure that those funds are investing in something that is on the same path that you are.
Right.
Because
Understand it.
Yeah. I mean, you can invest in a fund that is still notes, but those notes are going to be on, let's say, that they're lending on hospitality and office buildings and development of neighborhoods, where that's a bit more risky. You have to figure out what your risk factor is. Do you have enough runway, so to speak, in your investing world, that if you have a pullback or a downturn or a loss of some sort, you have plenty of time to gain it back. So you have to take the risk associated with it. If you're closer to needing the income to live on, you probably don't. You're not looking to hit home runs. If you are,
Right.
you have to look at Babe Ruth. He hit a lot of home runs, but he struck out 4
A lot.
times as many times as he hit home
Yeah.
runs.
Yeah.
So you have to keep that into consideration. So look at what the funds, what it is that they're trying to accomplish. What's their strategy? What kind of properties are they lending money on?
How long have they been in business? Who is the operator? Is it someone that you know, like, and trust? What's their reputation like?
Yeah, here's an important thing about the due diligence on a fund is how many third-party eyes are on the books at all times too.
Good one.
These funds are not publicly traded. They are SEC. They do have SEC documents. They're called SEC exempt, but they're private placement funds for a reason. And this is why most of the ultra wealthy are the ones that are investing in it, because they're private placement funds. It's not open to the public. That said, if they're not open and transparent with you, then there might be an issue. But you also want to make sure that they have other third-party companies involved, like a fund administrator. Do they get annual audits? I was going to say yearly, but that's what annual means.
Yearly too.
Yeah. Who handles their tax returns? Is all that done in-house or is it done outside? What you want to do, it may be okay for if you're doing your own tax returns. I would not want to do that. We have in our company, we have a third party that does the tax returns, a third party that does the auditing, and then we have a third party that does the fund administration. My suggestion, it's okay if you have one of those in-house, but I'd at least have 2 of those outside, just for your benefit. The beauty of investing in a fund, though, if you can qualify as an accredited investor, is that while you're buying notes or creating notes, eventually those notes are going to pay off. And now you're going to have to go find another note. And if you, let's say, for example, if you're looking at 11% interest rate on your note that you're holding, and that loan matures and pays off, and it takes you a month to get another 11% loan, well, then annually you've only made 9% because you had that 1 month gap. So being inside of a fund where the money is always working, or if you're loaning the fund money, there's funds that you can be the lender to the fund on. Some funds are going to be equity funds. Some funds are going to be debt funds. Again, this is some of the due diligence that you have to to do. And that's all part of the private placement memorandum. That's part of the term sheet that should be in all the documentation, excuse me, that they give out when you're looking at these funds. Also, it would be a good idea to see if they will give you names of some of the investors that are already working with them, so that you can, give them a call, shoot them an email, find out, what they think of them. Have they had a good experience with them, or do they communicate well? But as an IRA holder, if you're just growing, if you're looking for growth and you want passive that you don't have to think about much, getting into some sort of a fund that either makes loans or buys notes or does a combination of the two is a great investment for an IRA, because your money is always working, and then it's also always going to be tax efficient as well. Wendy, am I leaving anything out on that?
No, but I bet you a lot of this is on our next slide.
I'm not sure. Let's see. No, I'm actually going to quote one of my favorites. I hope he'll be around with us a little bit longer. The number one rule is never lose money. The number two rule, never forget rule number one. And so Buffett's emphasis on capital preservation is essential in real estate investing, just like it is on all his stock investing. Now, Warren doesn't really go out and buy stocks. He goes out and buys publicly traded companies, right? He owns a lot of real estate companies. He owns Berkshire Hathaway, which is a real estate brokerage. He owns Clayton Homes, which is a manufacturer of manufactured homes. He also owns the finance company that lends money to the people that are buying the Clayton homes. So he's definitely on the real estate side. So basically what he's telling you is that you need to conduct a thorough due diligence, consider the risks, invest in properties that have potential for long-term growth and profitability. That's assuming that you're buying the properties. In our particular case, we are more than happy to be in the lending position. Why? Because what we said previously, as a lender, you're only into the property for 60 to 70% of the value. And what we're talking about here is being in a defensive position. If you look at the stock market right now, it's the equities that are suffering. It's the income, the stocks that pay a dividend are the ones that are gaining ground. I mean, heck, you can get a 10-year treasury that's paying 5%. That's pretty safe. The problem is you have to hold it for 10 years before you get your 5%. There's a lot that can happen then. But you can get money markets for 4 and 2-year treasuries that are in the upper 4s, low 5s too. There's plenty of place to keep your money safe. And if you're in a position, again, everybody's different in their investing journey. And it just depends on where you are in that journey. If you already have what you want, you're just trying to preserve it and keep up with inflation, actually make more than inflation, but keep up on the inflation side. You want to be in a little bit more conservative spaces. And I love the lending part. Equities are going to suffer a little bit. And what I mean by equities is basically owning property for a while. If you own the right property, they're still going to go up in value. I think single families are going to continue to go up in value. One of the things that is little known right now is that most of your major home builders are not building single family homes. They're building apartment complexes. Even though we have a shortage of single family homes, they're building apartment complexes. I don't want to be a conspiracy theorist here, but I'm almost thinking that they're trying to keep the prices of homes artificially high by not building as many. That said, there's also not a whole lot of margin in single family homes, especially in the medium price point. So I can also see that as well. You get a lot more bang for your buck for the lot that you're buying if you can put up a multifamily property.
Yeah, or town.
You got anything to add to that?
Nope, I'm ready for the next slide. I don't want to beat a dead horse.
Okay. All right. So as I said, we've got some resources here on the note side. If you don't know anything about notes, we love these three folks. Eddie Speed, noteschool.com. He's got courses there and teaches you everything to know about notes, seller financing, all kinds of stuff. Actually, Wendy and I took his course. We've been in the mortgage business for years and years, and we learned stuff that we didn't think about. So Fred and Tracy, they have a business. They also do note training. Now, I know that Fred and Tracy will actually buy notes from people, but they don't sell notes. Eddie has a fund that he will also sell notes as well. So you can also work alongside folks with that, like Eddie and Fred and Tracy, to learn about it and then invest alongside them with this as well. That's a good way to get started.
And what's so great about both of these companies is There's others like them out there too. But what's so great about both of these companies is they teach you to think outside the box. They teach you how to be creative. Because people will say, well, what if I don't have enough money to do an entire loan or to buy a 100,000 note? I maybe only have 30,000. Well, they can teach you ways of being able to do the deal with what you have in front of you. And they understand IRAs too. Both of them are very familiar with how self-directed money works. And, you always, of course, want to do your own due diligence on there, but you need to be learning from people that understand how self-directed money works.
Right. And these folks are great resources. There's other people that do it as well. I just don't have enough slides for everyone. And I know these two personally, and I highly recommend them.
Yes.
And Wendy is correct. They teach you to think outside of the box. That's for sure. Okay. Part of the due diligence is that, and here's our contact info as well. We also have a fund. You can invest alongside of us if you like. But what I'm offering you here, if you see where it says billfairman.com, we have a due diligence PDF white paper that's available for you. It's 10 questions that you should ask a debt fund manager before you invest. It's free. We also have an ebook on the difference between debt funds, mortgage pool funds, and other types of funds. That's free as well. So go to billfairman.com, click on where it says free gift, and those things will be available to you. We're always happy to help you out with anything at carolinahardmoney.com. And then those are our direct email addresses. You can shoot us, either one of us, a note at Bill or Wendy at chmlending.net. Wendy also does something that not a lot of people do. She has what's called Wednesdays with Wendy. She devotes half a day on Thursday. She does individual 30-minute Zoom calls. Right? What'd you say?
No, I do it on Wednesday, not Thursday. That's why it's called Wednesday.
Did I say
Wednesday.
Thursday? I thought, okay. Anyway.
He is a much older brother.
on Saturday, she does work all day Wednesday.
Yeah.
So
anyway, it's a 30-minute free mentoring session. And we can talk about anything real estate you want to talk about. One of the great things about being on the lending side is that I am blessed to be able to have a 30,000-foot view over any deal that comes in front of me. I get to see all the players. I get to witness the successes and the mistakes. And I love to be able to share those with people. That's my goal. Like, people shared with me, and I want to be able to give back. So if you'll click on that, Wednesdays with Wendy, I'm happy to.
Well, actually, they can't click on that, but if they email Wendy,
we'll get you
them a link.
Yeah, that'd be great.
Yeah. So with that, we're going to wrap it up, Kyle. I think we're probably ready if you have any questions.
Yeah, perfect. And I've got just a little presentation myself to share real quick on the Quest side. I think Wednesdays with Wendy on Thursday is quite a concept. That's awesome.
It's been I'm here at a mastermind group. It's been a long week. Sorry.
Yeah.
His mind's been mastered.
Yeah. So I do just want to share a little bit on the self-directed side, how this all kind of ties together, right? And how you can use your retirement savings, your tax deferred or potentially tax-free money, right, in the Roth IRA or whatever that may be, to do this type of investing, whether it's going to be in a fund, purchasing or lending out yourself, purchasing notes, or drafting those up. An attorney is always a great resource to have to make sure that legal due diligence is done. But there are so many ways to do note investing, right, and structuring it, whether you want to be a little bit more passive or active, is kind of what Bill was referring to, looking at funds or looking at purchasing notes yourself or finding the borrowers. And you can do that through a self-directed IRA as well. It's a really common investment that we do see here at Quest. So please let us know if you have some more questions on that on the self-directed side. Obviously, Bill and Wendy answer, more on the investor side, on the note side. But yeah, you can scan that QR code if you do have some questions, want to set up some time to speak. This is just a little promotion we have going on right now for individuals that do set up accounts and move some money over to start some of these more alternative investments, right? And what Carolina Capital does and how they help investors, I would say, is so diverse, right? Because y'all's group, you're not only offer opportunities for lending out to real estate investors and like-minded individuals, but like Bill was saying, you guys have your own fund for people to invest into as well. So there are so many different avenues you can go down and options to look at there. The other thing I do want to mention here, this is actually, so we do a monthly, what we call a monthly social or mixer event, where we offer typically some kind of education, a lot of networking as well. This one specifically is only networking, the July events that we're hosting. So if you guys are in the Texas area, these are great to look into, whether you're trying to meet like-minded individuals, other real estate investors, potential borrowers. I mean, the options, I would say, are really endless. Houston and Austin will be I guess that's the first Tuesday, or maybe the second Tuesday of the month, the 11th, and then Dallas is on the 18th. So if you guys are local, I would certainly encourage you to check those out. You can actually go to our website under, I think it's Houston events, Dallas events, or Austin and San Antonio. Register for those there. So see if there's anything else. This is another event that we have coming up, speaking or regarding multifamily investing. Just another one of the many ways you can invest into real estate on the alternative side of things. And this is, I would say, probably the most popular investment we've seen lately. In IRAs, investing into apartment complexes or condos, multifamily projects or syndications, right? People that are raising money to build these giant complexes. So a lot of people also syndicate self-storage units and other things like that too. Parking garages is something we've seen before, car washes. So that kind of just speaks to, what I was saying before, the diversity in alternative or real estate investing. And I believe that's about all I have. So let me go ahead and pull this down, and then I want to put y'all's contact information back up here.
There's a question.
Yes. You're talking about the question from yeah, let's see. The first one here from Kareen.
Yes. What are your thoughts on mixed use investing? We actually are doing one ourselves right now, some mixed use.
Well, we're not doing the property, we're renting or we're lending on it.
Right. Yeah. And we're involved in an equity piece on it as well, but mixed use is a great way to go. It's again, it can fall into mixed use. It really is. You're going to have some commercial space along with some living space. And, it's always been popular. I don't think it will ever go away because people do like the convenience of being able to walk where they, have a walkable living area. They like to be able to live and work and walk and shop in the same areas. So we do like it. What are your thoughts on it, Bill?
Well, typically it's going to be a new development, and because there hasn't been a lot of mixed use that is going to be rehab type of mixed use, which means that there's always and again, we like the space, but there's always a little bit of extra level of risk with any new build It takes you a lot longer to build, say, a multifamily with a mixed-use commercial piece than it would a single-family home. And I always look at the longer the construction time, the more chances are that there's something that could go wrong or some kind of a black swan event that changes the market while it's going up. But
you're unlikely to get paid during that period of time too. A lot of times payments don't start until they're 12 to 18 months into the project. So understand that may be an issue.
Yeah. Now on a lender, if you're the lender, you're getting paid, or I don't lend the money. Just so you know,
it's whatever term you come up with.
If you're an individual and you can afford to not get payments, you're just looking for growth for a while, it's a big opportunity. But if it's a mixed use property, it's probably going to be fairly expensive, and you're not going to be the only one in it. My opinion. You have to have deep pockets for some of those. I like them. There's just a little bit more risk involved.
Mm-hmm. Awesome. Okay, and I am going to go ahead and share the website and Wendy and Bill's contact information there down in the comments. And we probably have a few more minutes for maybe one or two more questions if you'll have any. Go ahead and put those down in there.
I have a quick question for you.
Okay.
How many people are showing up live at your live events when you're doing your socials? About how many people are showing up for those?
I would say, yeah, normally we probably have around 50 to 60, maybe on average, somewhere in there. And it certainly depends on the topic or what we're doing. But yeah, I mean, there's so much opportunity to network there and meet other real estate investors.
And that's the key. That's the key. Networking is, you can't put a price on it. Breaking bread across the table from somebody, meeting them in an event where you get to talk about personal stuff as well as business stuff. You get to know them. You build that relationship. That's a great person to invest alongside or to invest in when you get to know them, because it's really about building the relationship. And when you're in a room with 50 or 60 people that are like-minded, what a great opportunity to be able to build your network and put your money to use, because it's making zero when it's sitting in your account, not doing anything.
Absolutely. And as they say, your network is your net worth. So
Mm-hmm.
Right. Yeah. And in actuality, it's earning less than zero because you have to figure in inflation too. So it's going backwards while it's sitting there.
Yeah. I love those events that you guys do. I wish y'all were closer.
I know. I wish we could kind of expand our outreach too. But one other comment I liked here. Oh, actually, it was this quote that you shared, Bill, on Warren Buffett. I thought that was really unique. Rule number one is don't lose money.
Yep.
Which I think is much easier said than done. But
Yeah.
as a beginning real estate investor, that's sometimes the biggest or the scariest part of getting into real estate investing, right, is not wanting to lose money, because a lot of times there is more risk associated than your typical mutual fund or money market fund, that doesn't carry as much risk, but a lot of times doesn't carry as much potential return with it as well. So sure. As you learn, as you go on, mistakes are going to be made, but it's just growing experiences. So that way, as you become more experienced and you get down the line of investing, or you're a more seasoned investor, you make less of those mistakes, and your track record as it relates back to never losing money is much better. So
that's right.
That's one comment I kind of wanted to make there too.
It's a good quote. It doesn't always happen, but that's your goal. And a great way to minimize the chance of losing money is to be more diversified. So scaling actually helps you lose money or less money. In other words, don't buy one asset. Don't buy one rental property. Buy 10 because you're going to have a stinker now and again. And you need the other ones to offset that. You're going to make money. But if you have 10 versus one, the odds that you're going to lose are going to be a lot less than if you just have the one.
Absolutely. Yeah. Diversification along with the due diligence is very key. Inside an IRA, outside an IRA, private, public, all that good stuff.
You know, there's another quote that I love so much, and I'm pretty sure it was Warren Buffett that said this, is you can always see who's swimming naked when the tide goes out. And Eddie Speed actually called me one day last week and said, there's a lot of people swimming naked these days, isn't there? Yeah, you're right. You know, everybody's been doing business based on this great, wonderful market we've just come out of. You know, they were making money just because you couldn't fail because the market was carrying them. That's done. It's over. That's not out there anymore. You have to really spend time on understanding what the deal is. And work off of good due diligence numbers. You need to understand what the value of the property is, understand what the exit strategy is, and how many exit strategies you have available. You have to do your due diligence. Whether you're going to be the borrower or whether you're going to be the lender, you need to do the same kind of due diligence and understand what the end is going to look like. You don't want to swim naked. Yeah.
Absolutely. Yeah, one of my favorite Buffett quotes that's probably a lot more common is can't remember exactly how it goes, but it's along the lines of you need to be purchasing real estate because it's the one thing they're not making any more of.
That's right. God's not making any more real estate.
Exactly.
Well, God is making more real estate. It's just not habitable for the next 100 years. It's part of the volcano.
There's some truth to that too.
It's much rarer.
Yeah,
absolutely.
For sure.
Well, I haven't seen any other questions.
We really enjoyed this.
Yeah, this is great. Thank you.
And a lot of times, they come 5 or 10 minutes after we end the presentation. So that's why I wanted to share Wendy and Bill's contact information. Feel free to reach out to Quest as well. You can go to questtrustcompany.com and find all of our information there, a lot of our education as well. So we really appreciate you guys coming out and really respect that the relationship you guys have had with Quest for such a long time as well. So thank y'all so much.
Thank you.
Absolutely.
We love Quest.
Yep.
Thank you so much. Well, everybody, thank you guys for joining today. We hope to see you next time. But in the meantime, if any questions do come up, feel free to reach out.
Thank you.
All right. You guys take care.